Okay, well, good afternoon, everyone, and thanks for coming to this session with the Pearson Center. Today we're going to talk about taxes. Some of us around this table, it's our favorite topic. Not all of ours, but some of ours. It's our favorite topic. But in particular, we're talking about that in a bit of a global context, actually. I think the timing for us, it's important for us as a Pearson Center to sort of get much more granular about our discussions around taxation and taxation policy. And we do have the opportunity to go coast to coast to pull in all kinds of different people for their opinions so that we can cobble it together and present it to lots of people, lots of stakeholders, those who are in positions to make policy, to debate policy, and we think it's particularly useful that a third-party, credible organization that is nonpartisan has an opportunity to talk about tax policy, because these days when you read about it, it tends to be from a very partisan perspective. So we've got some great speakers here today who really are experts in their field. A couple of board members here as well, I'm delighted to say, one of whom is a tax specialist in his own right. And that's not you or me, Catherine. But what we're going to do before we start is go around the table. I'm going to start with my right with the president of the Pearson Center. And for the sake of the two on the phone, let's just go around the table counterclockwise and introduce ourselves.
Andrew Cardozo, president of the Pearson Center.
Junaid Mirza, board member of the Pearson Center, also a transfer pricing expert at PricewaterhouseCoopers.
Heather Evans, I'm the executive director and CEO of the Canadian Tax Foundation.
I'm Jack Mintz, President's Fellow at the School of Public Policy at University of Calgary, and also a National Policy Advisor for EY. Nobody uses words anymore. They all use acronyms.
Vera Sijus, I'm a University of Toronto graduate and interested in public policy.
My name is Mark DeSormo. I'm an economist with Scotiabank.
Welcome.
I'm Caroline King. I work for RBC's leadership group under George Jack Mintz.
Welcome.
Catherine Cottress, board member of the Pearson Center.
Excellent. And Sandra Pupatello, and chair of the Pearson Center this year. And it is funny you say that, but when I was leaving politics and told people I was going to work at PwC, they said, wow, I didn't realize that you were going to move to Ottawa for public works. And it's clear that they know what the letters stand for, you know. Anyways, so just as an opener, here's how pardon me, thanks, Jack. Thank you. And the two on our telephone, can you introduce ourselves? We'll start with you, John.
Sure. Jonathan Kaloff. I'm on the Board of Advisors of the Pearson Center, co-chair Economy of Tomorrow series, but also professor at University of Ottawa.
Welcome, Jonathan. We've got one more on the line.
Hi there, I'm Jimmy Vu, Department of Finance. I'm replacing Don Wilson, who couldn't be here today with the budget in less than a week. He's very disappointed he couldn't be here, but I've assembled he's assembled a group of analysts here around the table.
David Esconizar.
Albert Wakari, personal income tax.
Nabila Nabi.
Gavin Hales.
Pierre-Yves Pratt.
That's about it on our end. Thank you.
Okay, thanks, and welcome to the analysts from the Ministry of Finance. And by the way, congratulations on an early date for your budget this year.
Thank you.
As a former member of a provincial legislature, I know they're doing cartwheels. They all want to know early on just how much they're getting, or if they have to start fighting with you earlier, you know. Anyway, so today we're going to talk about taxation policy, and the way the flow will go, Junaid is going to introduce our two guest speakers. They're going to make commentary first. Then we're going to open the floor to questions and have, I hope, a very good back and forth around this topic. And then we are going to close right at 4:45. That's the plan. And then we're taking copious notes based on our discussion, so please feel free to participate. And Andrew, I just want to say thank you on behalf of the rest of us who are all volunteers at the Pearson Center for organizing. Jonathan mentioned the Economy of Tomorrow series, which is a series that the Pearson Center has undertaken the last year and a half or so, and it really is meant to speak to really the economy of tomorrow from both an economic and social perspective. And this is certainly one of those topics that fits into that lot. Today we want to talk about taxation in light of what Trump has managed to do. And although we knew what he planned to do, I don't know that all of us believed he could do it. And in fact, now that they have implemented policy, my own experiences in economic development, for example, and as recently as the spring in speaking to international companies, even now that I'm in the private sector, recognizing that there has been such a long wait-and-see attitude with America that, in my view, has really impinged on their decision-making in making investments in Canada. They really needed to see what was going to happen in America because it's very well known how intertwined our economies are. Now that we see what they're doing from a competitiveness perspective on corporate tax rates and personal tax rates, the questions are, what's the impact on us? What should our response be? And what can we advocate, if any, so that it's actually good for Canada? And I think our finance minister has this as probably his biggest challenge in light of all of the discussions around NAFTA that really are, if there's a word, it's going to be uncertain. And business likes certainty. So I think in this topic area, we've got lots that we can talk about. So Sinead, over to you so we can introduce our speaker.
Sure.
Thanks.
Thank you. And they have already introduced themselves, so I won't take too long, and we'll jump right into the discussion. We're fortunate to have two of our leading tax experts in Canada here today with us. We have Professor Jack Mintz, who is a renowned expert on tax policy in Canada. We have I'm sure all of us who have any interest in tax have read papers and articles written by him. He's a President's Fellow of the School of Public Policy at the University of Calgary and serves on the boards of Imperial Oil, Morneau Shepell, and is the Chair and Vice President of the Social Sciences and Humanities Research Council of Canada. He's also the National Policy Advisor for E&Y, as he mentioned earlier. We also, and there's a lot more in terms of his accomplishments, I won't go through all of those, all of the positions that he has. We're also very fortunate to have with us the Executive Director and CEO of the Canadian Tax Foundation, Heather Evans. CTF is an independent tax research organization, which anyone who's worked in tax in Canada, we're fairly used to getting emails from CTF and benefiting from CTF's resources on a regular basis, including a newsletter from Heather on a regular basis. Before CTF, she was the National Managing Partner of Tax with Deloitte, where when I was at Deloitte, she was my boss at that point. So without further ado, we'll start the discussion. Sandra, do you want to kick us off?
Thanks, Heather. Are you comfortable leading us off in this discussion?
Sure, absolutely. I think that Jack has certainly lots of insights to share with us that he'll get to in a moment. But I certainly think that, maybe just to tee up your presentation a little bit, when I look at the U.S. tax reform and the Canadian response, I'm a bit of a student of history, and it's interesting to look back to the last time there was significant U.S. tax reform, 1986. And I know you were intimately involved then in some of the formulation of the Canadian response. And I just find it very interesting to contrast perhaps the response of the current government to what we saw then. And maybe it could be that the complexity and the abruptness with which the U.S. legislation was passed has certainly caused the government to take additional time to reflect on it. But I do think there is a need to communicate a bit more than has been the case in the last few months. I think that there's a bit of an appetite to understand what the government's thinking is. Perhaps some reassurance is required. I'm not suggesting that haste is necessarily the right approach in these circumstances, but there is a compelling narrative to tell about Canadian competitiveness. But for many years, we have relied upon a tax advantage that no longer exists. And so I think that there's really a twofold response that's required. One is to craft that narrative, which is really a global narrative around Canadian advantages. And the other aspect of action that is required is really around tax and tax reform in Canada. And in 1986, there was already an impetus to look at corporate tax reform. And what happened in the United States really spurred a lot of much more significant change on the corporate side, on the personal side, and of course led to the eventual introduction of the GST. So I do think, and I can maybe speak to this a little bit later on, but I do think that there is really a compelling need to step back and determine what the Canadian path forward should look like. not simply in response to what has happened in the United States, but perhaps as part of a greater effort to engage in reform of the Canadian tax system and looking at a variety of issues. I'm not overly optimistic there's appetite to do that at this point in time. I think that indications have not suggested the government is willing to embark upon that journey. But I do think the process that was undertaken in 1986 that ultimately led to a white paper was a very helpful one. I think bringing together all of the stakeholders to debate and discuss the issues, including the provinces, and talk about what a response might look like and what the associated challenges might be, would be a very useful and tangible step for government to take. As I said, I'm not overly optimistic that is what we will see in the coming months. Certainly, probably not in the budget that's happening next week. But I think in the long run, that's probably what would be healthiest for Canada. And I'll just sort of conclude these opening remarks. I mentioned being a bit of a student of history. I went back and I did a little bit of research, and there was a very interesting paper that was published about the impact of 1986 tax reform on tax reform in Canada by John Bostons at the University of Toronto. And the parallels are quite striking in terms of the issues that were presented by the U.S. reform back then and what the Canadian response might be and what the anxieties were amongst the business community and government. And I just found it very interesting to go back and read that article and reflect on the circumstances in which we find ourselves today. So I'll stop there and certainly allow you lots of time for your remarks, Jack.
Well, thank you very much. Just to let you know, I have had a very bad cough for the past 4 weeks, and I don't normally cough, but when I do cough, it is a terrible spell. So I hope I don't have it in the next 10, 15 minutes, but I'll try not to anyway. The other thing is I sent Andrew. I've been writing a lot on this topic, and in the past while, there's a lecture or a presentation I gave at EFO, which is a top think tank in Germany, on January 23rd that I sent to Andrew, and I told Andrew he can distribute it to anybody who's interested in it. It's called Global Implications of U.S. Tax Reform, and so it's very much focused on that topic. However, there's Thursday there'll be a paper being released by the School of Public Policy on the 2017 Tax Competitiveness Report, and there's a very long part on U.S. tax reform and implications. In fact, it's called, which is referring to 2017, the calm before the storm. The storm being this year. I expect 2018. We will see a lot of corporate tax changes around the world. Every country is now looking at this quite seriously, and I can tell you, in not talking to not just to Canadian businesses, but also, for example, when I was in Germany talking to a number of German large companies, everybody now is trying to figure out the implications of this reform and what it means to their investments in the United States and what they're going to do in the United States relative to Canada. And given our exposure to the U.S. market, and I should say that there's an old adage about tax reform, in Canada we sometimes try to shoot for the moon, but we end up in the United States. And I think this is very much where we're at right now. Now, I sometimes, when I look at issues, I like to think of what, especially public policy issues, what's the problem? And then talk about, is there, what solutions are needed? And in the case of, what's the problem, let me first of all say there is some good news associated with this U.S. tax reform, and that is in part because it's going to be adding to the fiscal stimulus in the United States. It will help it grow. But I think more important is that this U.S. reform is very much a productivity story. And when you think about it, especially the expensing of capital for machinery, just at the time when every board I know of, including Canada and the United States, is looking at, and around the world, at artificial intelligence, big data, and robotics, and new technologies to adopt to get down costs and potentially disrupt competitors. The timing of this reform, especially on expensing, will help facilitate more quickly the adoption of new technologies in the United States, and that could lead to the U.S. becoming much more competitive as a result. So even though a lot of people talk about the stimulus, the fiscal stimulus and impacting growth, I think they're missing the boat. They're missing the supply side story, which is going to be the productivity impact that this reform is going to have. Now, that it spells out good news for Canada in the sense that the U.S. grows faster, given we're, highly exposed in our trade to the United States. That could be a good thing for us, for many Canadian businesses that sell down to the United States. But I think there are 4 major areas where it's going to be investment that's going to be really challenged. And right now, especially in a piece I'll soon have coming out, Canada's investment record has been pretty poor over the past few years especially. And we need to pick up on private investment. Otherwise, we will have a serious problem in terms of growth in this country because investment is when people are start adopting the new technologies, and it's also the way that you make sure that you're not consuming all your corn today, but you're going to have some corn to produce tomorrow and consume at a later time, which is why you need to have investment. Private sector investment is absolutely critical. So let me very quickly go through what I think are 4 major challenges for this U.S. reform for other countries. The first one is investment, and this is what boards are looking at right now. Should we put more dollars in the United States, or should we put it into Canada? Knowing the energy sector right now in Alberta, I can tell you right now they've already voted. Money is going into the United States by Canadian companies. They're not investing in Alberta right now. In fact, the view is that we can't get oil sold out of this country. There's higher taxes, there are higher regulations. U.S. now looks extremely attractive from an investment point of view in the energy sector. I've heard some things, similar rumblings around manufacturing, especially in auto. There's a lot of pressure on the primes, on auto suppliers to locate more and more production down in the United States. And this reform will help a lot. In fact, the numbers that we do in terms of the corporate rate cut of 14 points in the United States, expensing for machinery, is that the effective tax rate will fall almost by half, from 34.6%, this is on new investments, to 18.9%. And this is assuming state income taxes stay exactly the same as they are right now. That will probably change. State income taxes, state governments are already looking at how they're going to reform their system coming year. Some supposedly conform to the U.S. base. If they adopt some of the base broadening provisions in the U.S. reform, then they may actually cut their statutory rates as well, depending on their position, vis-a-vis the changes that were made. It's fairly complicated what the U.S. states are going to do. So that's the first point to make, is that every country in the world today, and I should say every company in the world today with U.S. operations, are wanting to be in a market which is 20% of world GDP, is looking very much at this reform and looking at whether they should shift more capital expenditure, change their supply chains, putting more into the United States than what they've had before. And they're just figuring this out now, and we'll probably see more and more potential announcements in the near future. The second issue is financing capital. From a tax planning point of view, and Heather, you'll probably agree with me on this, over the years, because of the high corporate income tax rate in the United States, as well as the fact that U.S. multinationals had to pay tax on their dividends they brought back home, basically anyone with U.S. operations, whether it's a foreign company or a U.S. company, look to always try to keep profits out of the United States and maybe their costs in the United States, because you can get that deduction at 35% plus whatever the state income tax rate was on top of that. That's totally reversed as of January 1st. The game now will be to put more profits into the United States and potentially shift more debt, for example, to affiliates or to parents outside the United States, depending on whether you're foreign or U.S. multinational. So you can see U.S. multinational, they could bring back dividends now tax-free into the United States, pay down their debt, and at the same time leverage up their affiliates. Foreign companies will have the same incentive. Now, why is that? There's been several rules in this tax reform that's going to make it less advantageous to hold debt in the United States. One is the interest limitation of 30% of what's called adjusted profits. Before 2022, it's going to be EBITDA, earnings before the deduction of amortization and depreciation and depletion. And then after 2021, it'll be beginning in 2022. It's supposed to be EBIT. Yeah, in other words, it'll be 30% of your earnings after you deduct depletion, depreciation, and amortization. There's some other adjustments too. I won't go into the details. Not important. The main point is that for companies that want to avoid bumping up into these tax limitations, there'll be a real incentive to try to push your debt out of the country, especially under the EBIT rule. Not so much under the next several years, because most companies won't be affected by the interest limitation rule in the U.S., but they will be hit more hard after 2022. I should say there's no safe harbor in the sense that you could be not have a lot of leverage and still be hit in a downturn in the economy, where you're going to all of a sudden not be able to write off your interest deductions for that year. You can carry for them for indefinitely, but you still lose the time value of that interest deduction. So you're better off to try to shift your debt to other countries. And those countries that are going to attract it will be ones that are going to have relatively high corporate tax rates. And I hate to tell you this, Canada, with the corporate income tax rate now close to 27%, is actually more on the high side. In fact, most countries are now 30% or lower. Brazil's at 40, Chad's at 40, but we do 92 countries, by the way. And Germany is a little bit on the high side. But the other thing is that a number of other countries have their own earnings stripping rules and then capitalization rules. Canada actually has pretty weak ones. And so actually I suspect that if I had some room to move debt, Canada will be a very attractive place to move debt.
And that may be a deliberate decision, right? That is an
Exactly.
advantage. Yeah.
And so Department of Finance, I'm glad you're here to hear this, but expect some erosion in your corporate tax base due to that because of that. So we're going to have to look at that. Also, the U.S. is bringing in limitations on the use of losses. Well, they got rid of the minimum tax. Post-2017 losses, operating losses, can only be written off up to 80% of income in any year. So you can't use it at the same level as you can in Canada and other countries. So again, there'll be more incentive to move your income abroad. Plus, the United States is bringing in what's called the base erosion and anti-avoidance tax. I won't go into all the details here, but effectively, to avoid that tax, one of the things you do is try to get your taxable income bigger in the United States of your affiliate. If you're a foreign company, have more taxable income in the United States to avoid the impact of what's called the BEAT, the base erosion anti-avoidance tax. So this has actually significant impacts as well. Never mind the movement of investment and capital, but also financing will also be impacted. The third important change is with respect to intangible income. And intangible income, there will be a tax earned by U.S. multinationals on their accrued intangible income, whether they bring it back to the United States or not, doesn't matter. They'll pay it on their income abroad. And it's a minimum tax. It's a tax. It's not a minimum tax. It's a tax on what they're called their global income low tax. Their global intangible low tax income, GILTI, and it's defined as their kind of income net of their 10% rate of return on their tangible assets. It effectively includes things like the return on research and development. It includes your marketing, intangible marketing, sales, in mining, exploration, development. They did hive off oil and gas, interestingly enough. Not quite sure the logic, but mining gets included and oil and gas doesn't. Key point is that the rule is intended to make it more difficult for U.S. multinationals to push their intellectual property outside the United States and to actually have it bring it back home to be subject to taxation. And the other one is called FDII, Foreign Derived Intangible Income. This is a concessionary tax on holding intangible income in the United States, again defined as income in excess of the 10% rate of return on tangible assets. And it effectively gives an export subsidy for intellectual property and marketing and those kinds of activities, where you're going to pay tax at the beginning at only a rate of 13%, which is at the federal level, which means that if you're 27% in Canada, you're going to be 13% federally in the United States, plus whatever state income tax there will be on that. That'll be another very significant incentive to have intellectual property and in the United States and not holding it in Canada. There is a tax credit given for foreign taxes, but that would for 80% of the foreign taxes under it, which actually will claw back the value of research and development tax credits in Canada. So Ontario may find that its research and development tax system, tax credits, will not be as useful under the GILTI tax that's going to be applied. And then with the FDII tax, there'll be incentive again for companies to locate their intangible income in the United States. So this is going to have another.
So I'm sure, I don't know if I didn't get that. If there are other people that need a little more explanation, because I do. So just before we move on, I just need to understand that this last point you made means that if the government chose in this legislation to tax at a much lower rate, if that's in fact a disincentive for them to move that activity elsewhere, where it would be taxed at a higher rate, whatever the rate of that going country is. So if it's only 13, then they may as well do it here, which means they'll do R&D here, they'll do development for patents, et cetera, all here, or here being America,
right,
at a lower.
Right. Well, it's a little more complicated because if you put more tangible assets in abroad, you can lessen your GILTI tax. So the interesting thing is that, for example, you might set up research and development abroad, and you might be able to get more real activities. You have to have real activities as opposed to just holding intellectual property abroad. Mm-hmm. But then you would like to hive off the tangible income and put it into the United States. And it's the old problem that we used to have with R&D in the past. In Canada, we had a very generous R&D tax credit that got lots of R&D here, but a lot of the spin-off jobs are in the United States, and this will also create more. We may get some R&D here, but then a lot of the income to be generated will be down in the United States.
Okay, and how does that ultimately impact on what would happen otherwise with our R&D tax credits? Because they'd still be lucrative.
Well, the bigger the R&D tax credits, the lower our effective tax rate in the United States, the more likely you'll be subject to this GILTI, because you get a tax credit of 80% of your Canadian taxes paid.
So a company that has operations in both countries is not going to realize the benefit of the Canadian incentive, because the U.S. tax will essentially offset the Canadian
R&D
advantage.
tax credit. Which didn't happen before. If the U.S. company didn't bring back dividends, if it left it abroad, then you've got the full value of the R&D tax credit.
Right. I'm just thinking of those examples where a number of our big manufacturers have homes and R&D in both the U.S. and Canada, and multinationals, like a Toyota, for example, with a big footprint in Troy, but doing R&D here as well. Now, even as a multinational, they're going to be incentivized to go more in the U.S.
It may well be. Now, the U.S. is eliminating expensing for R&D after 2027, I think it is, or 2026, and going to amortization. So they're going to write it off over 5 years. Now, by the way, who knows what Congress will do to this package in 5 10 years?
Right.
And my mind is, right now, let's focus on the first 5 years, because I suspect there'll be a lot of changes before 10 years are up. But not everything will change.
A lot of these measures are temporary. So query how sticky they are.
Well, the corporate ones are permanent.
Right.
Yeah.
Right. But some of the others.
The personal ones, I'm not going to talk much about the personal ones, because those are all going to be phased out mostly in 10 years, and they could be made permanent by Congress before the 10-year window is up. It's just because of the Senate budgeting rules where they have to balance after 10 years, called the Byrd Amendment.
Right. The other caveat is...
But the corporate tax, the only one that's phased out is expensing. So there's 5 years, 100% write-off, and then it'll be reduced 20% per year. Yeah. But if you look at the history of bonus depreciation in the United States, it's just bonus depreciation at 100%, although it applies to used property and not just new property. You look at bonus depreciation. Bonus depreciation was brought in 2001. It was abolished at 50%. It was abolished in 2004 for 3 years. It was brought in 2008 or 9 at 50%, then bumped up to 100%, and brought down. It was supposed to be phased out by 2020 completely. My bet is that Congress will do something, whatever it does, in 3-4 years' time with expensing. They may not continue it for 100%, but they may, they may not phase it out, or do it a slower phase out, or make a permanent change. Who knows what they'll do.
The other aspect of these rules that's challenging right now when you drill into specific examples is that we don't have regulations yet from U.S. Treasury, and these are really complicated measures. And as soon as you start to get very specific, lots of issues arise, and there's tremendous uncertainty. And you also need to analyze it by sector. So as Jack mentioned, it's completely non-intuitive that oil and gas and mining would be treated so differently, but they are, right? Maybe it's a political reason, who knows? So it's very difficult you can speak in generalities about these rules, but as soon as you go one level down, there's a lot of caveats that come into play.
So, the main point is that, still, these are huge, it has created a completely different view of the U.S. in terms of companies and what they do. The other fourth change is with respect to what's called pass-throughs, or what we call flow-throughs. These are companies that don't pay taxes themselves, but all the income is attributed to the owners. So that would be, for example, limited liability corporations, which many companies have LLCs as well, or limited liability partnerships. And an important category is what's called subchapter S corporations, or S corporations, which are mainly, you might think of the smaller businesses that are of that type, owned primarily by Americans. There is a concessionary rate on active business income, not on passive income, but on active business income, and they went to some length to hive off service income, so professionals can't take advantage of it as much, the lower rate. But the key point is that when it comes to things like venture capital and businesses doing active business income, we've already done analysis of it in the past. We're just updating it now. But it is now much more, when you take into account both corporate and personal taxes in the U.S., it is now much more, a much stronger incentive now, tax incentive to be in the U.S. compared to Canada on the small business side. And that's another major change. I'll just quickly add one final thing, and that is solutions. And I won't go into a lot of depth right now, but maybe this is up for discussion. But in my view, Canada needs to think of the following. First of all, we have lost the business tax advantage that we built up over the past 15 years. And that makes any disadvantages, including our small market, an issue. And of course, if we lose access to the large market on trade, that could be a very serious problem as well. And I think you have to remember that in the U.S., there's a lot of variety in state income taxes. Some very important competitors are state competitors have no corporate income tax. Texas, for example, and Ohio. So if I was an Alberta company, I'm thinking about Texas. I'm not thinking of other parts of the U.S. And so the average state number doesn't mean anything to me. What means a lot is 21% in Texas versus 27% in Alberta. If I was a company that is in manufacturing and I'm looking at Ohio versus Ontario, well, Ohio is 21, Ontario is 26.5. So in terms of corporate income tax rates. So I think we have to remember there's a lot of variation in these rates, plus the GILTI tax in the U.S., the FDII, the foreign-derived intangible tax, the concessionary tax for intangible income, will create some issues. So that's one thing. My view is Canada really does need to at least have some reduction in the corporate income tax rates. My view, part of it may be signaling it in this budget with a 1-point cut, with potential down the road depending on what's going to happen. Canada may also want to think about investment tax credits for machinery. I don't like this policy necessarily because it creates distortions, but maybe this is a time, where the government is thinking about artificial intelligence and all these new innovations, but frankly, we won't have anyone using them except American companies if we don't do something on encouraging Canadian companies to adopt new innovations. R&D is not just a matter of creating ideas, it's also a matter of adopting new ideas. And I think we have to think very much about that. And in the case of R&D, we may want to think, again, what the federal government started doing a few years ago, but should we be switching more to grants from tax credits so that we don't get clawed back by the GILTI tax in the United States? Third is I think we do need to think about some of our base broadening in the system, particularly on the international side, as there's potential base erosion. And fourth, I think we should really look at some of the provisions in our taxes, and this gets to general tax reform, where there are things that are not working out that well, like the Atlantic Investment Tax Credit, the labor-sponsored and venture capital credit, which I think was a huge error on part of the federal government to reintroduce it 2 years ago. It was right that Ontario got rid of it. It is ineffective. It has hurt the private venture capital market. You can talk to people in venture capital industries who will tell you that. It was a very ineffective incentive in encouraging venture capital. And if we want to do something, I think we need to think a little bit carefully. And certainly one of the biggest mistakes are the passive income rules under the July proposals on private corporations, because a lot of venture capital was going into private equity. People who were successful sold off their businesses, put their money in private corporations, and then they're buying other corporations or funding new startups. And I know somebody told me in Waterloo, for example, the July rule on passive income has really dried up private equity for startup companies right now in Waterloo area, because a lot of the people that were going to fund these companies are now not doing it because of these passive income rules that they're afraid of. So they're going to wait to see what the budget brings. But if the federal government makes a big mistake here, I think that is going to be to the detriment of Canada in terms of venture capital. There's some other things I can go into, averaging capital gains taxes and mining incentives, some of them that we should get rid of, not a matter of bringing them in. Capital gains tax rates, actually, I would argue, are a bit too low right now in Canada. But then if we brought in averaging, I think that would be a very helpful step because we're at a point where we are advising people in risky type activities because they, as soon as they, in that 1 year, they sell out or they cash out and they end up being hit by the top rate one, which now we have more progressive rate structure, we have to worry about that a lot more. So I think I'll stop there.
Okay, very good. Thanks so much. And just before we jump in, Heather, with more of your comment, I wanted to introduce John McKay, who's been a long-serving MP from, I had to ask, Scarborough-Gilwood is the official name of your riding, Center of the Universe. Thanks so much for being here. It's certainly very helpful. And I think there may have been a couple of people that joined on the phone as well. We have John Callis from the University of Ottawa and an advisor to the Pearson Center, as well as a group from the Ministry of Finance. Are there others on the phone? Okay, they might be lurking in there, not wanting to say. Anyway, John, thanks. It's great to see you here today. And I know this is extremely topical with the budget date that's now been announced for the next week or so. Heather, could we ask you to jump back in?
Sure, no, I'm happy to do that, and thank you. Very interesting and always well-considered remarks, Jack. And there's certainly lots there to talk about. Maybe I'll just pick up on a few things. I talked about some of the uncertainty in relation to the U.S. proposals without regulations, the fact that some of them are temporary measures. But I think the general message is one that is, I think, very positive for business. And I think what's really struck me from the U.S. proposals is that, and I've had lots of conversations with colleagues and contemporaries from south of the border, is that there is, notwithstanding how this played out in terms of the vote and how the law came to be passed, there's fairly broad bipartisan support for most aspects of this legislation. So I think a lot of Canadians think, well, it's coming from Donald Trump, we just have to hold our breath and eventually this too shall pass. But I think it would be false hope to assume there's going to be a major course correction, even if there's a change in U.S. government. I think that this signals a very meaningful shift in U.S. fiscal policy. And I think that, as I mentioned at the outset, I don't think Canada should or could react in haste. It's complicated. It takes time to assess this. But I think it would be a real mistake to not take the opportunity to reflect on some of the measures that Canada could take to regain our competitive position, and not just reliance on tax. I don't think a race to the bottom is the right answer, but there's a good story to tell, and it needs to be told, and the right people need to be brought together to talk about some of these issues. And it worries me that that's not happening, that we really to date all we've heard is the Prime Minister at Davos saying he's not going to reduce corporate tax rates, and that's fine, but there has to be more to the story than that. I think there needs, as Jack said, businesses are making decisions. They already are. They're having conversations with their advisors already about relocation of operations. And it's not just a transfer pricing issue. We're talking about moving people and physical operations rather than trying to shift profits to different jurisdictions. So it's fundamentally a much more substantive exercise. So I do think that narrative is really important, and it concerns me a bit that we haven't heard a lot, especially if you look at the holistic nature of the U.S. changes. And you mentioned, Jack, you were going to talk about personal tax, but the rates in the U.S. at the personal level are, depending on your state, they're for the most part not dissimilar to Canada, but the threshold at which the highest marginal rates kick in is fundamentally different. So Canadians are paying tax well north of 50% in most provinces now at rates that are about half the highest, the rate at which the threshold at which the highest U.S. marginal rate would kick in. So that's a factor as well. And of course, if you're looking at reducing tax rates to try and regain some competitiveness, you have to fund it from somewhere else. And I mentioned at the outset sort of the lessons from 1986 and the GST coming in. I think one issue that you didn't touch on, Jack, but might be worth discussing a little bit is the relative mix of taxes, right? And where do consumption taxes, indirect taxes like GST come into play? And is there an opportunity to rely more on that as part of a broader tax reduction-based broadening exercise on the income tax side? I don't know what your thoughts are on that, or if that would be politically unpalatable. But I think the government has to look at the different tools to fund some of these options if a tax reduction is on the table.
I just think it's very hard to, maybe on the personal tax you can change, but it's very hard to say that you're raising the GST to cut taxes on corporations.
Agreed.
Tough sell.
Yeah, it is. It's an impossible sell.
That's why I think the base broadening approach is
preferable. The other element of uncertainty around the U.S. proposals that is maybe a bit of an esoteric point, and time will tell, but some of the U.S. provisions, especially the provisions that deny full foreign tax credits or effectively function as alternative minimum taxes, although they're not called as such, raise competitiveness issues with the WTO and potentially issues with violation of the U.S.'s network of treaties, global treaties. So part of the dialogue the Canadian government could be engaging in is raising some of these issues with contemporaries. So at the EU, at the OECD. I know this dialogue is happening in Europe. Canada really hasn't been visible, and maybe it's too soon, and that's fair. But I think that would be something that we could and should expect as well.
But that will take 5 years to resolve.
Not to start talking about it. To resolve, yes. But to start surfacing the issues.
If it gets resolved.
Because other countries have, I think, very similar concerns.
Mm-hmm. Well, their main objection is to the foreign-derived intangible income concession for intangible income in the United States, which is viewed as an export subsidy, and also the base erosion anti-avoidance tax. But no one's going to object to the U.S. lowering its corporate tax rate, as it's done, and no one's going to object to the U.S. adopting a dividend exemption system for multinationals, which is done by every other OECD country, and no one's going to object to their interest limitation rule, which is already done by a bunch of countries as well. And I think the U.S. can argue, I think, on the base erosion and the avoidance tax that, in principle, this is not that much different than the earnings stripping rules that have been used for limiting interest deductions. And I think they'll have more trouble with the foreign-derived intangible income treatment, which is this looks like this export subsidy on intangible income. That has real effects. I already know some companies in Canada, they're looking at moving their sales forces down to the United States, which they did the opposite over the years because the U.S. rate was so much higher than the Canadian rate.
I don't know if you'll remember a couple years back, it could have been more when the Americans suddenly decided to eliminate their version of the EDC, Export Development USA, and they just decided they weren't going to have one anymore, and it lasted about 6 months.
Still talking.
Pardon me?
I don't think it's funded yet.
It's still, they certainly reversed the decision, though. So as soon as they decided they could see that their own companies now didn't have that option for use, it wasn't very long before they decided, okay, I guess we can't do that anymore. So I'm not sure about its funding level today. I just remember.
I think it's still an issue from whether it was an issue and it was raised, and I think there's still an issue over funding, permanent funding.
Yeah, it could be that it isn't permanent or something, but it was interesting that the moment they took a big step, what they thought was perhaps, savings or whatever, they realized a huge impact on their American companies, and then they reversed the decision. And I think, I was kind of hopeful, frankly. I was delighted that they were eliminating that because it was a big advantage for Canada as the EDCs become quite aggressive in a very good way globally, helping American companies, doing all kinds of things globally, and people would be surprised how it's enhanced our supply chain activity in Canada because of what they're doing in some other country, And anyway, so I did think that they, it's a whole different group. This was under a different era in the U.S. But based on some of your commentary so far, even if we talk about this budget coming, or Heather, to your point, whether it's a proper consultation process on this topic, which hasn't happened officially from the government, even though there are people on the outside that are talking about it, do you think we're better off leaving the tax per se and speaking more to other elements of incentives for business? And just leave the tax alone completely? Politically, you don't want to talk about increasing the GST, or politically, you don't want to talk about dropping the corporate income tax rate, or whatever. So is there enough meat in other activities that would ever benefit us enough?
Well, just first of all, remember the U.S. corporate rate. Actually, I was going to calculate a trade-weighted corporate income tax rate in the United States. Nobody ever calculated, vis-a-vis Canada, no one ever calculates that. I suspect it's lower than we think. But when you think of it, I do think we do need to lower corporate rates a bit in reaction. Otherwise, companies will play against the Canadian system. Again, if you're, a company in Texas, Ohio, or Washington State, and I have a 21% rate, or in some other states that have relatively low state level tax rate, and I'm looking at 27 Canada, even 5 points can make a big difference about, transfer pricing decisions and things like that. So from a point of view of protecting our own base, I think we need to think a little bit about the corporate rate as well. But also, I think we need to do some base broadening, especially on protecting our tax base in Canada, as there will be this incentive to shift costs into Canada because of these other rule changes in the U.S. And one way to kind of give something back is lower the rate a bit too, which also helps on the base erosion side too. So that's why, leaving aside the investment decision, I think we need to do that. Are there other policies that we could pursue?
Sorry, just don't leave that yet. When you talk about, how would you disincentivize them from moving their costs into Canada?
Well, I think we need tougher thin capitalization. Right now, it's easy to get around them through guaranteed debt and things like that. They've been tightened up in the past several years, but I think we need to think a little bit more about that area. And it's going to increase. It's going to make, it will be a tax hike on companies if we tighten up on our interest capital, on our thin cap rules. That's one area. I think we have to look at some of the other things too. Under, international taxation is a very complex area of taxation, and we may want to do certain things that make sure that we do protect our tax base. But I think on debt, that's a big item in my mind. General administrative expenses is another one. Transfer pricing as well. But there's been, there's a whole methodology to transfer pricing. It's not as simple as one thinks to shift income, but you can do it. Intellectual property is an area where you can shift income very easily by licensing arrangements. This is why Singapore has a lot of pharmaceutical companies, and and our Bermuda and places like that. Insurance is also in, these low tax jurisdictions. So there are things to think about, I think, that we could do. But if we do toughen up on the base side, I think the best thing is to use the revenues gained to lower corporate income tax rates in Canada, which will be consistent.
I would agree that, but with that completely, that would be helpful. I also think there's a broader narrative, as I mentioned earlier, to talk about whether it's our immigration policy, healthcare, highly educated workforce, the level of innovation, albeit not specialized perhaps as we might like today. I think there is a broader story there to tell, and I think, to be totally candid, I think we've been a bit complacent for the last number of years because we had this tax advantage, right? And that was sufficiently compelling to drive a lot of investment.
Because we're able to get the capital.
That's right.
We can have great immigration policies, and we do have very good education system, things like that. But we won't be able to take advantage of those things if we don't get capital. You need capital too. And we did that with our business tax advantage we created for many years.
Right.
But now it's gone. That business tax advantage is now a disadvantage.
So, for example, the accelerated depreciation, which used to be a big selling feature for existing companies and where they're going to place their next investment, enhanced machinery,
It was
whatever.
only manufacturing.
It is very narrow.
We have never done that for services, and we're way off. I mean, I'll just, one of the things, we do a lot of these calculations, but I can tell you on the industry side, we still whack services, communications, transportation, much more heavily with taxes than you find in the United States. Communications is really important. I mean, we have this kind of protected communications sector to a large degree. But the U.S. reform is going to be driving the effective tax rate on communications much below the Canadian one, even more so than the numbers I gave. Yeah. And in fact, it'll be like 23% Canada, 18.5%.
So do you think that that's an area to look at, which is moving that accelerated depreciation for investment in capital across more than just manufacturing?
Well, the U.S. does it for all machinery, for all sectors.
Because if we're going to focus on AI and we purport to be interested in all of this IT, and we've got huge IT industries in these, now superclusters, that maybe that's an area to work on, although it's very costly to government, I would think.
Well, but
if they make the investment.
But think of that. I mean, we created 5 superclusters at $2.4 billion, including, that's both the private and the public sector contributions. $2.5 billion is a spit in the bucket compared to the total investment needs of the country. And so, yeah, maybe it'll create some jobs, do some good things there, but we have a much bigger set of issues on our hands.
Yeah, I only meant supercluster from the fact that there's IT embedded in all of them, and we have clusters, certainly
Right.
3 big ones in Ontario.
But are we just going to create artificial intelligence and then just sell it down to the United States, and all the manufacturing jobs are in the United States, and all the communication jobs are there, and everything else? Is that what we're going to do? I mean, Google, sure, they're taking advantage of Canada. Our human capital, our education subsidy. I was on a panel with the previous CFO of Google. He was going on about, we need to put more money into funding university research for artificial intelligence in Montreal. He says we're hiring a lot of people in Montreal, that are educated in Canada. I said, that's great. We should put a tax on Google hiring of to help pay for that education. By the way, they end up moving people eventually down to the United States. But anyway, we should get you to pay tax.
Yeah.
We should pay, and by the way, then that could fund the subsidies for Bombardier. I thought that
There
would
we
be
go.
great.
So this strikes me that my middle child is an engineering student at University of Waterloo who's currently working for Google in New York.
Oh.
Well, actually, I mean, we don't know, by the way, even with immigration flows, what's happening. Sure, we might be getting some people from third world countries, but, how many people right now are we losing, young people going down to the United States? I don't know. It's a number we have to look at.
So when you look at the Canadian response, you talk about impacts on sectors are very different depending on, specific rules in the U.S. and how they play out. Would you suggest that a Canadian response has to be a sector-specific response, or is there an opportunity for a broad response as well?
My own bias is I would be a little nervous about a sector-specific response because you've got government picking winners and losers, basically, which always makes me a bit nervous. I think something that's broad-based would be preferable, right? And the U.S. there's a lot of politics behind what they've done, and I'm sure you've looked at the legislation. There's a lot of results in there that are completely non-intuitive, and there'll be a lot of amendments in the coming years to fix many of the problems that are in there. I wouldn't suggest we want to emulate that.
Yep.
I think a broad-based approach would make a lot more sense.
I would agree. And also the other thing is that, don't forget, we undermine our productivity when governments start picking losers and winners versus losers, because often they go to the losers because they're the ones crying the most for subsidies because they can't make it in a competitive world, and then and in fact losers really know how to pick governments actually, and so I think, as I always like to say, and so I really think it's important that we do take try to keep to a policy that we've had actually since 2000 of trying to get to a to make sure that we have a similar tax burden on all industries and not try to favor one over the other. There is an argument to subsidizing research, providing research support, because firms can't fully appropriate the returns on the research. They do it themselves and then it benefits other firms, but they can't capture all the returns in their innovation. And that's been the argument for support of that type. But I think once you start picking sectors, that's not necessarily the best approach to use. I think it's better, you just never know where the technology develops and who's going to do well in the future. That'll be what people do. So you look at the forest industry; they've been going through a lot of technological change. Oil and gas is too, and things like that. We're still a resource-based economy, and so I wouldn't want to start saying, we're going to pick that sector and that, in that sector, to get benefits. I think we should take a more broad-based approach, and that actually, I think, improves productivity in the economy rather than reducing it.
When the Americans had a higher nominal rate, the argument was, well, the effective rate was actually quite similar to ours. So with this change in Congress, change the nominal rate, what has happened to all of the other incentives, depreciation, whatever, that actually brought down the nominal rate to the point where it was effectively the same as ours?
Well, a lot of them have, not everything, but a lot of them have stayed. So in fact, with expensing of capital, it's even more generous than past bonus depreciation. So that's even bigger than it was before. The other thing that I followed the evolution of the tax reform in the United States for the past year very carefully. And if you look at the original House plan, they were getting rid of certain energy tax credits and all, and oil and gas tax credits and things like that. The Senate dropped them, actually. So a lot of stuff kind of stayed there. But by the way, you have to be really careful about these effective tax rate comparisons between the United States and Canada. Over 50% of business income in the United States is in flow-throughs or pass-throughs. And some people were comparing taking corporate income taxes as a share of all business income, which was really not appropriate, because if half of it is not being taxed because it's in a flow-through, but there's much more personal taxation of it, it's not really comparable. So you have to be very careful when you do that. And once you do that, it actually is, the effective rate in the U.S. actually goes up quite a bit if you just look at corporate income and kick out all the flow-throughs.
And flow-throughs, you see them largely in real estate, for example.
Yeah, real estate investment.
And speaking of real estate, and I think I completely agree with you that hopefully we can change the narrative in Canada and not have a race to the bottom, as you said, Heather, especially globally, because we still need our own national industries and such, and employ our own across the globe. But what about real estate, for example? example, all of our different levels of government where there are different advantages to locate different companies based on a healthy comparative advantages and create more clusters, as you were saying. We're moving from an extraction or resource-based economy into a more high-tech oriented economy, even with biotechnology, and we're moving into a greener economy. So we need more local incentives to bring business. So all levels of government hopefully can work together to craft out and even select and try to retain the industries that are already here through lower tax rate, lower real estate or property taxes, those sorts of things. What about other labor incentives? We have a much more grounded and beneficial social program in the United States. Everything's a la carte. So personal tax rates are effectively higher because they do have to pay for all of their various other social requirements, whereas they're met with here. So how do we graph those social attributes and with the contribution of the other levels of government to keep? And again, AI, artificial intelligence, is so new, and yet we've been, U of T has been heavily involved and is far ahead in their research. Where do we capitalize on that?
Yeah, I mean, so you raised a lot of very interesting points. I'll touch on the first two and leave the AI just for the moment. So I think that the Amazon situation was quite instructive, and the deal book, if you haven't looked at it, you should. It's online. Everyone can take a look at it. I think it's a really compelling story about why an organization might want to locate in Toronto, with contributions from all three levels of government. And it contrasts with, we may not eventually be successful. In fact, I suspect we won't be. It'll probably be somewhere in the U.S. But, you know, you contrast that with the money that U.S. Municipalities were basically throwing at Amazon, who certainly does not need corporate welfare. And I think, you know, it's very interesting to see how three levels of government came together and highlighted all the different advantages that are present from carrying on business here, and why it's attractive for employees to live here, and all of the associated advantages, economic and non-economic, financial and non-financial, that can come from operating within the Greater Toronto area. Whether that's sufficient, Toronto, as I said, remains to be seen, but I think maybe that is a bit of a precedent for future collaboration. Canada is not a large country. Obviously, we're large geographically, but from a population and the size of our economy, we're not large. And I think we need to see more of that collaboration to be successful on the global stage, as opposed to, you know, the types of disputes that are happening even right now between maybe two Western provinces we won't name, but a little bit of war over wine, from what I understand.
Well, actually,
Ontario is very, very.
Well, actually, I
ship our wine
disagree
to
with your
Calgary.
comments on two grounds. The first ground is that, you know, countries succeed in partly due to their comparative advantage, and resources have given us a huge comparative advantage as a country. And in fact, you know, we're not the only one that has succeeded with that advantage, and there's nothing wrong with it. And there's a lot of investments in a lot of high tech and everything else in these industries as well. And so the bigger issue, though, is areas where we don't have comparative advantage. And I'm not sure government should be creating one through a bunch of subsidies. I'm not sure that is actually a winning strategy in the long run. We have to create our comparative advantage by doing things well and doing it efficiently as a business sector. And that's the challenge that the business sector has in doing it, and I don't think the government should be responsible in picking which are the industries that we're going to have that comparative advantage. And I think it's very clear. And to give you an example, I mean, we look at 92 countries. In fact, we do quite a bit of analysis. But take Sweden, for example, which does have very high tax rates on personal income and labor. And they also have a very strong social welfare system for, you know, for people. But the interesting thing that Sweden does is it taxes capital at a very low level. They have a corporate rate, first of all, corporate income tax rate of 22%, 5 points lower than ours. and they also have a number of things that we do in their system that actually leads them to have an effective tax rate on capital investments that are below ours already. And I think they have figured out, which is what a lot of economists often recommend, is that when you have mobile bases, which is capital, those are the ones you don't tax heavily, because those are the ones you need in your country too. It's your immobile basis that you can tax more heavily, which tends to be labor. People don't move that much, except for your very high-skilled labor. And so actually the answer to when it comes to what is your best type of tax policy, don't tax mobile capital or mobile factors as heavily as other factors. And that's what most countries have been doing. If you look at Sweden and all the Scandinavian countries, they've adopted dual income taxes, where the tax rate on corporate income and capital income is a lot less than on labor income. And that's been done there, and it's very common now in a lot of countries to have more concessionary rates towards capital, because they want to make sure they get capital investment. And so we've done that too in Canada. And I think the answer is not increasing our to making, well, I think we still have to make sure we have a competitive tax system when it comes to capital investments. And in some cases skilled labor too. I think that's an issue. But that's because you're mobile factors. But you can do that while at the same time still offering a good social policy system, which we have done in Canada, as well as making sure that we have a system that actually encourages, I think, the best growth possible, for a country. And that's why I think policies that we adopted since the mid-90s in Canada, getting our fiscal house in order, which we've done to a large extent, and also having a more competitive tax structure, because back in 2000 we actually had the highest tax on capital amongst all OECD countries, and we got down to the middle of the pack. But we're starting to move up. We're now, out of all the OECD countries, we're about 14 with the highest tax on capital, and now the U.S. has gone below us, so that makes it 13.
Sorry, not by virtue of us increasing, but by others decreasing, correct?
Well, no, we went down quite a bit. We actually, since 2000,
I mean, back in the
and it was
States,
all federal.
recently, the others are now catching up because they're now employing better tax policies or adding.
Well, some of these countries, we've actually had some of the most, when you add it all up over 15 years, 2000 to, well, actually to 2012, we had the biggest changes that occurred on the corporate tax side. It just went very slowly, but we didn't do it like the United States, one big swoop in 1 year.
Would enhanced financial architecture help with capital investment? If you had a harmonized securities regulatory system that improves upon our segregated, all of our different securities commissions across the country, which do not have the strongest enforcement, they don't have the greatest. Would that help with capital investment?
It would help a little bit, but it won't have a dramatic. It'll have something. It will be positive, but it won't be
Streamline things.
Yeah. I mean, there's lots of regulatory things. I mean, that was the other thing that the Trump administration has done over the past year, has been deregulation. Huge amount in energy, agriculture, et cetera. This whole thing, every new regulation with reduction of 2, we've actually had more reductions in regulation. But it has actually been, especially in the financial sector and in a couple of other sectors, energy, there has been a significant amount of deregulation. One can get in debate whether it's good or bad, but it has happened. And if you look at what's happening in energy now, it's going gangbusters. And in fact, oil and gas, oil production in the U.S. This is one forecast, which is a little more aggressive than the International Energy Agency, but done by a fairly reputable group. They predicted in the next 5-6 years that oil production in the United States will double from 10 million barrels per day to 20.
They already surpassed Saudi Arabia,
No.
I've read recently.
No, but if they go to 20, think of it. They consume 18 million barrels per day. So that means they're going to become a net exporter in oil within 5-6 years.
And that, I mean, you touch on an issue as well.
And deregulation
yeah.
has a big impact.
It's the uncertainty around regulation in Canada. I think that is the challenge. Not so much the sheer volume of regulation that could be an issue, but the uncertainty, especially in the energy sector. It's businesses need to be able to make decisions, right? And that, with NAFTA uncertainty layered on top, is causing a tremendous amount of angst.
But it's not just energy. If you look at
That's just one example.
No, but if you look at the World Bank, they do an interesting comparison across almost 200 countries, 190 countries, roughly. And Canada does very well in certain areas of regulation. One of them is actually we run a really good tax system in terms of compliance and administrative costs. We're in one of the top 10 in the world. And I can believe that. I worked in enough countries around the world that I can tell you Canada's pretty good on the whole compared to a lot of other countries. And there are areas we're pretty good, but there are certain areas we do really badly. One of them is permitting, getting a permit. And all you need to do is talk to people, urban planners, trying to get a development in the city. This was the World Bank, the example, not as an example, the survey that we had was building a commercial warehouse. Canada, we were like 119. Fastest out of 190 countries.
Our productivity and our net GDP.
Yeah, so if you want to know, getting goods to Tidewater, way slow. Slower than the U.S., way slower than Australia. We're way slower than Australia on permitting. Getting a contract written, very slow. So, there's certain, actually it was very interesting because they go through a whole bunch of things. Some things we do really well on, but there's some things, especially around what I would call infrastructure, we do badly. We do very poorly.
Has our immigration process improved compared to the U.S.?
Oh, we've had a much better immigration policy because it's been less family-based and more on merit, which is really what the Trump administration is arguing for right now. Wish he would make it more clear.
Exactly. Although he did at one point think he wanted a Canadian-style system. I think.
No, but actually it even came out lately. They said it, but it doesn't. I wish he would say it.
Could I jump in and ask if Jimmy or John or anyone in Jimmy's group has a question for our speakers?
Yeah, actually, Jonathan here. One of the things I appreciated from Jack, from what you were talking about, is I'll call it pragmatic tax policy, meaning what are companies actually doing, not at the theoretical level. So you've painted a bad picture in terms of the investment flow from Alberta, but what I haven't heard from you is what are you picking up in terms of what foreign governments are going to be doing in their tax policy in response to the United States? So what are we responding to?
So far, they're kind of looking at it. I don't know what the Germans will do. They're going through right now the difficulty of even forming the governments. And so there's, it's not entirely clear what they're going to do so far. But also, they're not as exposed to the U.S. as we are.
Right.
In terms of their operations and things like that. In the work that I've done, probably the countries that are going to be most concerned are going to be the ones that tend to tax capital pretty highly. So I got a communication just yesterday from India, where the Indian government is definitely looking at this in terms of how they should respond, because they have pretty high effective tax rates on capital, even with the significant value-added tax reform they just recently did, which was very positive, actually, on capital investments. But they still have a lot of other things in their system that lead them to be actually one of the highest in the world. The Latin American countries are going to be very sensitive as well to this because of their exposure to the U.S. As well. I haven't heard yet what they're thinking of. I think part of it is that a lot of businesses are just starting to mull over exactly what they're going to do in response. And because of as Heather said, the tax reform was so fast that people weren't sure it was going to happen or not, and it's complicated, that they're just sorting it out now. So I had, for example, I had a meeting with one of the major companies in Calgary 2 weeks ago because I was there, and they are certainly looking at what they should do vis-a-vis investments versus Canada and the U.S. but they're also looking at some of the provisions that they need to plan around now, particularly the base erosion and anti-avoidance tax, the BEAT, is one that they were quite concerned about. But this will depend. I met a company in Montreal that isn't worried at all about the U.S. reform. Why? Because they don't have that much exposure to the U.S., and so they're not too worried about it. And in fact, they don't have many operations in the United States, so they weren't concerned.
Just on that point, Jonathan, I was going to tell you my own experiences on a public board that I'm on with our debate at the table around securing our sort of hedging our bets and making sure that we have an alternative plan for our production out of Mexico, that it can move easily into the U.S., that we're doubling up on what our plan would be for transporting of these goods. So a lot of the detail in the NAFTA discussion is very pertinent to this company. And the other side of it is, speaking to some of these American business people who are involved in our board, some of the work we're doing is just to make sure we don't get in their crosshairs. What can we do that's really good as a Canadian company in the U.S. so they'll leave us alone, basically, and make some decisions, which we've since done. And, making investments in the U.S. that I can't say for sure they would have been in Canada, but we would have had a fighting chance. But otherwise, it's really the time to show some investment in the U.S. so they can fly it up the flagpole if they need to. And that is strictly a business decision, even though it's emotional-based versus fiscal, which is really interesting, for a bunch of Canadians who are doing business in the U.S.
Right. This is important discussion because, Andrew can tell you that many years ago we set up an early warning system for the government through the Alliance of Sector Councils where we said, what are your companies actually doing now in the recession? So we were the early warning system. And, Jack is somebody that foreign governments and companies are going to approach and say, this is what we're thinking of, and perhaps as Pearson, we need to think about that sort of an early warning system where we use our network to let the government know what the talk is at the board level and at the foreign government level, because we can't be reactive. We can't keep responding, and we'll be in trouble because in a speech I gave to the EX group, I said capital moves quickly, not like it did in the past, and foreign governments will take advantage of weaknesses that they see in a very quick basis. So, Jack, I appreciated your comments, and Sandra as well. And Andrew, I think we need to start looking at how we tap into this on a proactive basis.
Okay. Jimmy on the line. Anyone from your group have a question?
No, we're good here in the department. Thank you.
Okay. Are you enjoying the discussion, Jimmy?
Very much so. Thank you so much for inviting us.
Okay. Thanks. We're all smiling over here. Can I ask a question? I don't want to jump in if there are others that please do just jump in. In your opinion, how would you rank tax policy as, say, the top 5 reasons for investment, for foreign investment? So if you're an international company and you're looking, like Amazon may have, although their list, I think, had other things on it that weren't necessarily items on a balance sheet, where would you place tax policy?
I don't.
The automatic question that's leading is what else is there on the list?
It's the wrong question to ask because there's many things that determine investment, and ranking one thing over the other, it all depends on the situation of the company and things like that. But what we do know from economic studies, and a huge number of them, the taxes do matter to a certain extent. So if you're talking about right now in Canada, I'm just trying to remember what our total private sector investment is. Let's say $500 billion. And if you raise taxes a little bit, maybe it wouldn't have that much of an impact. But if you raise, or if you have a major change, like we're going through right now with the U.S. change, but if you have a major change, then that's going to have a significant impact, even if it means a loss of only $25 billion over $500 billion, but still a fairly important loss. Now, the number I usually use is that for every 10% increase in the cost of capital, I'm not saying 10 percentage points, but 10%. So let's say 5 to 5.5%. The loss in capital stock is roughly 7%, which is a large number. It is a relatively large number. It's not a big elasticity, as economists would define, but it's still pretty significant. Because you also have to remember that that's going to have important ramifications through the economy. Because our ability to pay workers higher wages depend on productivity and capital investment. And in fact, that's always been the biggest issue, is that a significant part of the taxes on capital end up, especially the corporate income tax, end up getting shifted back onto immobile factors in the economy, which is labor.
And I guess I'm saying that I think that our trade agreements are going to have there's a bigger risk for us right now than a discussion about tax policy.
Yeah.
Right? And I say that based on,
I don't know.
most of our companies are all in the southern part of the country, right across the country. They all loosely used, do business with the U.S. mostly, 75% to 80%, right, depending on the sector. And this, I was on this investment tour in India, 4 cities. Every single city, with a different group of business people, every single session began with what's going on in the U.S., followed by, I think we better wait to see what we're going to do, because our pitch has always been, come to Canada as your gateway to the U.S., because people come where they have customers.
So this is what worries me.
In this instant,
but
that's
this
why.
is what worries me the most. We've had a strategy in Canada when you go back to free trade and tax reforms around then, regulatory reforms, privatization, things like that, where first of all we would make it more attractive for people to invest in Canada. But and so we did the GST, and we did, provinces have dropped into the HST to a large extent, at least most of Canada, and we've done a number of deregulations that I think have been pretty good. And so we've made it more attractive, but at the same time we've had free trade that gives access to the U.S. market. So it was a twin strategy in my view. This is being upended this year, where we're losing the business. We're losing some of our advantages. We still have advantage on, I would say, the workforce and education, but we don't have an advantage on capital anymore, on attractiveness for capital investment. And if anything, right now, the signal about Canada, and I've been hearing this from investor presentations in the U.S., not just in energy, but also manufacturing and others, people are starting to look at Canada's high tax, high regulatory costs. Why? Because governments are signaling that right now, toughening up in regulations, raising taxes,
and
which they've been doing.
The private corporations rhetoric feeds into that as well.
Exactly, and the private corporation rhetoric did not help at all.
No.
But this is investors, foreign investors in the United States, looking at Canada, and they say, you guys look more politically risky now. We're less interested in you. And I'm sure that's, some of the other countries around the world are starting to look at Canada that way too. Now with this U.S. tax reform, U.S. now is more attractive from a tax advantage. It is, on the regulatory side, more advantage in a number of areas, not in all, a number of areas. They have a large pool of labor. I don't think their human capital is as good as ours from a per capita point of view.
Our base is higher.
But they have a big population. But let's face it, they also have a big market. If you're in the United States, you have 350 million people, and even though there's some regulatory differences across the states, as we know, it doesn't matter. It's easier. Once you're in the United States, it's easier to deal with all the states and try to do it from Canada. And so we have these disadvantages. And I think now that we've lost that business tax advantage, all these other things get more exposed. And some of them you can't overcome, the market. And NAFTA, if it falls apart, that raises the wall even further in terms of getting into the United States.
So can I ask then, on a positive note, all the things the things that really are still our competitive advantage from either a tax perspective or other. We mentioned in passing immigration, to the extent that matters, a skilled workforce. I guess I'm assuming that when we say immigration, we actually mean skilled workforce, or one that's coming in now already educated that we don't even have the cost of educating them, which is like a bonus, right? So let's say skilled workforce, and for some sectors that matters. I just, and I know, Heather, you've mentioned a couple times that the narrative isn't wide enough. It's always, come to Canada. You're not coming for the weather. So You're coming for something, and it's going to be, we all say, and I have heard this recently, I try not to get my back up, and they say, come for the educated workforce, as if we're the only country now that has an educated workforce, and that just isn't true. There are other places that have nicer weather that have very good education, and I can't believe how much weather plays a part in where people want to live. No, the older I get, I'm having to face.
There's a reason why the United States is 350 million, we're 35 million.
They're mostly more south than we are. I know. Well, and I will always joke, but I come from Windsor. We are 800 kilometers south of Vancouver in my hometown, and it makes a difference. At least 4 weeks of fabulous weather more. So in February, I think of that. But in any event, all to say, what are those positives, in your opinion, where we're still hanging on, maybe gripping with our fingertips, where maybe a little more bolstering in this area, given new focus in technologies, AI, whatever all these,
But everybody's doing that. That's a problem.
I get that. So where is ours?
Oh, that's when it goes back to comparative advantage. I hate to say it. Resources is one area we have very significant comparative advantage.
Right, and since 1700, saying,
we're starting to hurt ourselves on that through our own regulatory.
Yeah.
Going to the issue of comparative advantages, the U.S. has basically bought down the tax rate with fiscal insanity because their deficits are massively out of control. They just keep on adding to the debt, At this point, the conversation is not is out of control, but presumably among reasonable economists, the concerns are starting to rise. And I would have thought that Canada's relatively fiscally sane situation should, in maybe not the immediate term, but the short term, start to play somewhat to our advantage. I haven't heard any conversation about the U.S. fiscal insanity, the continuous run up to the edge of the cliff, et cetera.
I think the deficit issue in the U.S., I think, is more than the tax issue. So on the, I didn't talk about this, but on the tax side, first of all, the Joint Committee on Taxation, which used pretty, I would say, conservative focus estimate, suggested that you have to remember that there was a rate cut, but there was a lot of base broadening too under the U.S. reform. So, it didn't go the whole way. It did $1 trillion over 10 years, balances at the end because of the Senate rule. So it would add by 2027, it'll add, under the Joint Committee of Taxation estimates, it would, in terms of impact on extra growth, which they do in the U.S., they do dynamic scoring, then instead of a $1.5 trillion cost, it'll be about $1 trillion. It'll add, that will be, you can expect the U.S. GDP to be around $28 trillion by that point. So under their estimates, so then you're talking about roughly a 3% add onto the debt GDP ratio, not the deficit, the debt GDP ratio. Now, if there's better growth, and so, for example, a colleague of mine at Boston University, he runs a fairly sophisticated model internationally, Larry Koplikoff, with 17 regions, and the trouble with the Joint Committee on Taxation, they have more of a closed economy approach, so they don't take into account the international factors as much, and also the fact it may actually drive lower taxes in other countries on capital. But Larry doesn't have reactions of other countries either. But if you take Larry's argument, he says that over the next 10 decades, you're going to have an increase in household income per capita of $3,500 to this tax reform. This is due to growth. Skilled wages will go up about 6.8%. Unskilled wages about 5.2%. This is in total over 10 years. But his estimates is that the impact in terms of the actual cost of the U.S. tax reform will be almost negligible under his model. So it all depends on
all attributed to growth. So they sort of
because he has a higher growth factor than the Joint Committee on Taxation. So it really all comes down to how much impact do you think will have on growth?
Budget office buy that bond?
No. I mean we've had back and forth with them actually because I've been involved a little bit on that. But No, because they use the closed economy. They have a different model. So they say, no, we're more conservative. You know, economists are pretty bad at the supply side stuff. And I think one of the supply side stuff is animal spirits. And the thing about this U.S. tax reform, the personal tax stuff is really unimportant. I don't think it's going to contribute to more growth and do that much, actually, on the personal tax side. Where I think the big changes is on the corporate tax side. And I think that's where you're going to see this, I think, important benefit. Now, the question is, will it lead to the U.S. having a 0.2 percentage point increase in growth rates, which is not insignificant on a longer-term basis, or will it be 0.5, or 0.4? Makes a big difference to your revenue for you.
And what does their growth rate need to be for that fellow's modeling to work?
His growth rate, I can't remember it now. I don't have it in front of me.
3, something?
No, he didn't have 3. It wasn't that high. He had it was higher than the JCT, but it was not as, like by another 0.2 percentage points or something.
I think you said 6% over 10 years for the personal income, right? So.
Well, that was on wages, so skilled wages. But let's say on personal income, 3,500 would be,
right now?
Yeah, approximately about 6%, I think. And so over 10 years, so you're not talking about 3%, or like a percentage point per year. It won't be that.
So could I go back and ask you again? Andrew's telling me that we're almost out of time. I can't believe it. We are. We don't really want to let you go, to be honest. Where would you say then our best strengths are in foreign direct investment or in expansion for our local companies? Where is the best advantage for Canada? I know
I've always taken the
sector. You said
again. I don't like governments. I mean, I kind of like Heather. I don't like governments picking the sectors that are going to win and the types of technologies and their comparative advantage. I think my view is you try to have a set of policies, and I think we've been doing this over the past 20 years. A set of policies that kind of make that encourage, that allows more growth, but it's people figuring out themselves where best to grow. That's why, for example, I'm a great believer in a carbon tax or cap and trade system with a uniform price on carbon, and then letting people figure out how to reduce carbon. What I don't like are all these implicit carbon prices right now through regulations like renewable standards and ethanol requirements and this and that. Because if we really, if we had taken more of a hands-off approach, I have seen scenarios of getting down to low carbon that could be established in all sorts of different ways. And it's all a matter of which technologies win in the end. But we can't predict that. But people who make the investments, and eventually they'll, if they have the incentive, they'll do it. So that's why that's an example. But if we had taken more of a hands-off approach on carbon pricing and saying, okay, we're going to have a uniform price, and we'll let people figure out how to get around it and adopt the technologies to reduce carbon, I think we would have been a lot better off than what we're doing right now.
Okay,
and it's a good example.
Not answering my question about...
On purpose.
Okay.
No, because I don't think it's right.
So if you were to say education is probably Canada's best strength because we've got more per capita in terms of very high-end schools.
That's a general policy.
But not one that the federal government has a lot of influence in.
Correct.
They do fund, but they fund sort of after the fact. They've not,
That's definitely
energy. They don't have a national energy grid, for example. So you have this very inequitable method of energy and pricing across the country, which can't be helpful to business. It isn't, right? And you would think as an energy-rich country, we'd have figured that out a long time ago, but we haven't.
But those are more general policies.
But if the federal government's role is in a more generic cross-country, then where can they pick a spot to do better in than they're currently doing so that it actually is something they can focus on? If we're not going to win on tax cuts, which we won't, because if they're determined in the U.S., we want to be the lowest. Well, we've never chased to the lowest here in Canada,
but I think
right?
you should distinguish between tax cuts for capital versus tax cuts for labor.
I have to tell you, as having been in government,
two different things.
you look at what you're looking ahead to as a government, you know, where's your revenue coming from? The CIT was the most unreliable number ever. You never knew how much you were getting. It could be off by billions.
I used to help Ontario with the forecast.
Until you knew that, right? So, right, and then all of a sudden we have, oh my God, we got all this money in this year. Why? Well, we have no idea why. Every company made their decision that year to write off this, but not that.
No, but my point is
So the CIT, from a governmental perspective on how much money they'll get and therefore what they can do with it, it's actually quite unreliable.
No, but let me go back to tax structure matters. So, just as a general policy. So, again, let me go back to the Scandinavian countries. Scandinavian countries have taken an attitude that we can afford our social policies and the kind of society we want. And and they have high levels of taxes. Sweden's at 60% of GDP. Mm-hmm. But the one area they don't impose high taxes is on capital.
I get that. However, they have not changed
because
that
they figured that out.
In my entire lifetime, that's never changed. So they've never had to go from high corporate to high personal. They've always been high personal for my entire...
but we lowered our corporate rates in Canada.
You see my point, though? It's a different political game to have to go from 50% to 60%.
No, but all I'm saying is
not what they've done. In my entire generation, they've never had to do that.
One of the policies is to improve the tax structure. One of the policies. Yes, education could be good. I'm glad we do what we do. Our immigration policies, as long as we keep the merit-based approach, I think is good. But we have to ask, there's a lot of things we do well in Canada. We're not going to be able to create that much more advantage of what we're doing now. Yes, we can run things a little bit better, but we've had low productivity growth for a very long time in this country. Mm-hmm. And we haven't yet found the solution about how we could pick it up. We're not doing what Israel does with 2 to 3% growth rates in productivity. The United States has traditionally had 2%. They've been down to 1%. My bet is I could see them going up to 2%,
right,
or 1.5% in the next decade. But productivity is something that you have to really work on through a number of policies, including regulatory policies and education and tax and things like that. Mm-hmm. But I can tell you now, some of the things we do in the tax system does not help in productivity. Especially throwing incentives at inefficient incentives at economic activities that don't need to get that kind of reward.
Yeah, you did mention that earlier on about looking at the tax credits and actually looking at what actually does not work and get rid of them. I don't know that there's been that kind of an exercise, because you never really see who takes advantage of these tax credits anyway, and was it always what the government expected?
Well,
look what we've done on small business.
And there's tax expenditure review.
We've just made the situation even worse with even a lower tax on small business active business income, and created a bigger differential. And yet you've had a lot of economic studies that have shown that actually they encourage the small businesses to stay small. It hurts their productivity. There's no gain to doing that.
There was a tax expenditure review that was done. The problem is the big ticket items are all the sacred cows, right? So there's some nibbling around the edges in the last budget, but there wasn't really meaningful progress again.
But it was also an exercise to raise taxes, not to cut the rate.
Yeah. But it also examined the effectiveness of some of those expenditures, or lack thereof.
See, I don't want to just, if you just raise tax levels, then you're not going to help, especially in today's world.
Mm-hmm. And that base broadening, what do you mean by that?
Cutting back some of the incentives in the areas. So we did that kind of calculation on accelerated depreciation and, certain tax credits. We found that you could lower the corporate tax rate without hurting government revenues, not taking into account any growth factors. It was just a static estimate. You could get the corporate rate down to 23%, at the general rate.
With the same revenue.
With the same revenue.
By reducing...
Eliminating certain incentives in the system, accelerated depreciation.
Do you think that any of
small business tax, the small business deduction?
Do you think
which was a big item actually?
Would any of the states take up the room that the feds are giving them on tax?
They might. We'll have to see. It'll be interesting to see what they do this coming year. Of course, the U.S. psychology is very different than Canada.
Mm-hmm. Yeah, but, the state-level taxes are very high, In
the U.S., no.
Depends on the state.
They're deductible.
Depends on the state, but
they're deductible.
I used to make a very specific list of the states we'd compare our
No, but if you calculate the corporate income, I'm not talking about the personal.
I'm talking about state tax.
Yeah, I'm talking about state. So if you look at right now, or in 2017, the federal corporate income tax rate was 35%. The state level governments added another 4 points on. In Canada, our federal rate is 15. The provincial governments added another almost 12 points on.
No, I'm aware of that, but
Yeah.
states do differ.
No, they do differ, but it's all deductible. So the top corporate rate in the U.S., I think, is Iowa at around 11.88, or I forget the number. Let's say 12% or whatever it is. And then you got 6 states at 0. And then you got a whole bunch that are well below 5, and they're deductible from the federal one. But the average state level tax in the United States is 7%. GDP weighted.
One of the arguments that hasn't been put forward, and again, you're talking advantages, disadvantages, what the government should react, shouldn't react, is, how should you say, the ill-guided attempt to achieve some greater level of income equality, which I think was behind the initiatives in the summer. Google Analytics will tell you if you want to live the American dream, move to Canada, because you have a much greater chance of moving out of the lower quartiles and moving into the higher quartiles here than you do in the U.S., almost twice the chance. So, so as I think about your argument that leading to a kind of a conclusion that we have to respond to this initiative by the administration, I'm wondering how the attempt, however crude, on part of the current government's efforts to make incomes more equal, less disparate, shall we say, maybe is in fact creates a social harmony which does not exist in the U.S., which is not insignificant.
I think you raise a really important point. I was actually discussing this exact point with someone last week, and Jack, you'll correct me, I'm sure if I'm misstating this. Gentleman was an economist, and he would posit that the levels of income inequality in the United States are actually a huge drag on their economic performance and would offset a lot of the competitive advantage that lower tax rates might seek to achieve. And I'm not an economist. I can't comment on that. He would suggest the literature would support that assertion. But I think that intuitively many of us as Canadians are very uncomfortable with the level of income equality that we see in our southern neighbours and a lot of social problems that stem from that, and would be loath to replicate that type of social structure in our own country. And that's one of those factors that I think is hard to measure. Correct me if I'm wrong, perhaps economists can measure, but I do think it factors into the mix as to where organizations choose to invest. And I, in my previous life, was around many tables assisting clients with making those types of decisions. And Sandra, tax is always on that list. It's not at the top of the list, it's not at the bottom of the list. It's definitely a factor. But some of these intangible elements are given a lot of weight as well, particularly when you need to relocate employees, right? If you're talking about a highly talented, skilled workforce that you may not be able to replicate in a new jurisdiction. So I do think you raise an important point, and I do think that that's part of the story that needs to be told. That really I don't think all of these different threads are being pulled together right now in a way that is compelling, because we've been able to simply rely upon our tax advantage for a long time. But as that has fallen off, the other factors, may remain static, except for perhaps trade uncertainty, which has deteriorated a bit. Those factors, I think, need to be brought to the fore.
So again, going back to an important issue, though, is it's one thing to talk about taxation inequality, social policy that we have in the country, and what's conditioned on that. And I think that's very much a personal tax issue, and sales tax and other types of taxes that individuals pay. The bigger question is, in the end, who pays for the corporate tax? In other words, is a corporate tax part of the progressive tax system or not? And what a lot of economic analysis would suggest today is that corporate taxes tend to end up getting shifted back onto labor, and actually ended up being regressive, especially on large companies, not small companies. Because small companies, high-income people could shelter their tax in a small company. But when you're talking about big multinationals, that actually you put more taxes on them, you actually hurt the population, not a lower income population, because it'll end up getting passed through as higher consumer prices or lower negotiated wages with immobile labor in that country. And that's what a whole bunch of studies show, including some Canadian studies. And so I think, again, if you're trying to address the inequality issue of corporate taxes, I think there's not much evidence that would support that that's the best way to go in, to try to get.
Your argument would be lower corporate income taxes actually create more social equality. I get that.
Possible, right.
And that's how should we say, an indirect benefit.
Right. I mean, it's more complicated because of
Sure is, yeah.
low, when you have personal income tax, you can undermine the personal income tax because you need a corporate tax to make sure that people pay their tax. But when you're talking about multinational investments and large corporate investments, you can argue that putting taxes on them actually is regressive, not progressive.
Speaking about base broadening, do you think that there's a lot to be said for an underground economy in Canada that we have yet to capture and get them paying their taxes?
Yeah, I mean, there's been various estimates done on the underground economy. Some using what's called a monetary approach to get a much higher number, share of GDP than others. And we do know that in certain areas like construction, there is a lot, tax evasion that goes on, not just vis-a-vis the GST or the HST, but also the income tax, which is usually the big one, really, for people to avoid. And, can we address that? Well, again, that's an argument actually for trying to keep some of the rates lower and bases broader so that you do a better job capturing the rate. Because when you start pushing rates really high, that encourages people to try to avoid taxes more.
Well, when I see sort of a CRA focus on the tips for waitresses, for example,
yeah,
I don't know if those people should pay taxes on tips. I don't know the answer to that question, but I do know that business people who don't pay taxes, I get really mad at them for what I know I pay. So there is even a more sympathetic response from the public to get everyone to pay taxes, never mind waitresses who we now need to decide whether we're going to tax their tips. There is that. So politically, it's a better bet to go after tax evaders. Whether that's, meaning more inspectors on the streets from the CRA, I don't think that's positive, but I don't know that they've ever figured out how, because I think governments always speak to it. They always say, and we're going to capture, the 5% that slip away, but we never really do. So
They're becoming a lot more sophisticated in their methodologies.
Yeah, but I also argue that the more complicated we make our tax system, with a lot of special provisions, this and that, special incentives and things like that, actually the more it encourages tax evasion. That's why I used to tell governments around the world, that you're actually making your problem worse, because you're losing this revenue here, you end up bumping up the rates here, and you're making things very complicated for administrators. They have to spend more time trying to say, what's a, like the food exemption under the GST. What is necessary food? What's not necessary food? You're ending up spending time on this sort of stuff.
And we're moving to.
And then people start trying to avoid these taxes because the auditors get so busy trying to deal with all these different margins in the system.
Okay, I guess I did think that over time the automation of this CRA versus their clients, the more we automate, the more onus.
That could help.
They've become much more sophisticated in terms of auditing, especially for non-compliant behavior, using sources of information outside of the tax return filing process.
Correct.
Right, so for example, FinTrack data, catching transfers of funds coming from overseas over a certain threshold, land transfer tax information subject to provincial privacy requirements, which are problematic in some provinces, including Ontario. Those types of tools they have not used in the past. Social media.
Interesting, yeah.
Well, there's a very much, and big data is being used in a much more sophisticated sophisticated way by the tax authorities around the world.
And Globe and Mail investigations.
Yeah.
Did
So.
they ever name the three in the Panama Papers? Did they ever say who they were?
I don't know.
Said they were gonna,
You know, I got a funny story about the Panama Papers. So, there was a company I was once associated with, anyway, and they were listed in the Panama Papers because I saw the list. So I phoned them up and I said, were you guys, running things? He said, somebody must have used their name because it wasn't us.
really?
Oh, no identity theft.
Yeah, exactly.
Or that's a really good answer.
Or that was really good.
Yeah.
No, I think we were never doing anything through Panama.
Wow.
Yet they were on the list.
They were on the list, wow. Well, okay, President, I know we've overshot our time, but the two of you are really very, very interesting and topical. And for our sake, it's really good for us sort of get some wind beneath our sails here too in this discussion, because we do constantly marry this discussion around social benefit and economic benefit around our discussions. And I think that's it's never just a pure tax discussion. It's always what the cost of that is and that sort of thing. So I would like to thank you both. I think officially you have Janae thanking our speakers. I should stop.
Oh, was that, okay, well,
That's the plan.
Go
yes.
for it.
I thought Andrew was thanking them, but that's
Well,
okay. No, so thank you both of you. This was a really engaging discussion, and I personally took a lot out of that. And I've been spending the last 8 or 10 weeks actually looking through the U.S. tax reform and the various proposals even before that as well. So, what I think has been lacking a fair bit in the discussions that I've been part of before is what should the Canadian response be, and it was the proposals or the ideas that you have put forth today. There's a lot there for us to go back and think about, and hopefully we'll come out with a paper on that we'll share with you as well. And as Pearson Center, a big piece of what we are focused on is actually coming up with the pragmatic, practical policy ideas that we can share with both our elected officials as well as bureaucrats to guide the discussion or to lead the discussion that actually results in then policy changes. Andrew, I don't know if you want to add to that.
You just took all thoughts out of my head. This
Okay.
is a great piece. No, that's really helpful to figuring out what we do next. And I think I'm quite interested that you're concerned about it but not panicked and don't think everything should be or will be in the budget next week, unless John knows differently than us. But I mean, I think you're saying there's a story we've got to be told, and the solutions are a bit more complex and long term, but we've got to get to them. We can't waste too much time.
I think that's fair.
So thanks very much for that, and thanks for everyone here and on the phone.
Thanks for having us.